Welcome back to the channel. My name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. I keep talking and meeting people that tells me the things that they've read or watched in the headlines. And here's the thing. Don't believe everything you read or watch. There are many things that headlines overlook. For example, right now, the latest existing home sales inched up 0.8% in October. You might be saying to yourself, well, Mac, that's less than 1%. That's hardly news. Well, the thing is, this is probably what you're getting in the media. Number one, foreclosures are spiking today. Number two, rising mortgage rates will slow down the housing market. Let's talk about these two before I get into the latest housing market update. There are a lot of questions right now regarding the real estate market as we head into 2022. The forbearance program is coming to an end and mortgage rates are beginning to increase. With all of this uncertainty, anyone with a megaphone from the mainstream media to a lone blogger has realized that bad news sells. I mean, really, that's why the title of this video is somewhat negative. Kind of clickbait. Because if I were to say the housing market is great, no one cares. Unfortunately, we'll continue to see a rash of troublesome headlines over the next few months. To make sure you aren't paralyzed by headlines, I share updates like this with real facts and real world experiences. Like I said, there are already alarmist headlines starting to appear. Here are the recent topics you might have seen in the news. Number one, foreclosures are spiking today. There are a number of headlines circulating that call out the rising foreclosures in today's real estate market. Those stories focus on an overly narrow view on that topic, the current volume of foreclosures compared to 2020. They emphasize that we're seeing far more foreclosures this year compared to last. That seems rather daunting. However, though it's true foreclosures have been up over 2020 numbers, one can even say soaring, it's important to realize that there were virtually no foreclosures last year because of the forbearance plan. If we compare this past September to September of 2019, the last normal year, foreclosures were actually down 70% according to ATTOM data. Think about that. The last normal year comparison were actually down 70%. Here's a quote from one of ATTOM's executives. As expected, now that the moratorium has been over for 3 months, foreclosure activity continues to increase, but it's increasing at a slower rate, and it appears that most of the activity is primarily on vacant and abandoned properties or loans in foreclosures prior to the pandemic. Unquote. This means that even the properties that are getting foreclosed were properties that were already in the process of getting foreclosed prior to the pandemic. Homeowners who have been impacted by the pandemic are not generally the ones being burdened right now. That's because the forbearance program has worked. I've said this before in this channel. My gut feeling is that there were a lot of homeowners in forbearance that really didn't need it. They might have just been playing it safe. Here's another quote. This one's from Ali Harrelson, president of auction.com, explaining how the forbearance program has been a remarkable success. The tsunami of foreclosures many feared in the early days of the pandemic has not materialized thanks in large part to the swift and decisive foreclosure protections put in place by the government policymakers in the mortgage servicing industry. Unquote. Now, for all the things that we complain about, our government sucks, this was an absolute slam dunk that really helped a lot of homeowners. And as if that was not enough, the government is still making sure homeowners have every opportunity to stay in their homes. The director of the CFPB, or the Consumer Financial Bureau, issued this statement just last week. Failures by the mortgage servicers and regulators worsened the impact of the economic crisis a decade ago. Regulators have learned their lesson, and we will be scrutinizing servicers to ensure they are doing all they can to help homeowners and follow the law. Unquote. In other words, the lessons of the last mortgage meltdown was learned. No way, no how that they're going to let this happen all over again. The second big thing you will see on the news is rising mortgage rates will slow down the housing market. Another topic that's generating frequent headlines is the increasing mortgage rate. Some people are expressing concern that rising rates will negatively impact the housing market by causing home sales to dramatically decline. The resulting headlines are raising unneeded alarm bells. Now, to counteract those headlines, we need to take a look at what history tells us. Looking at the data over the last 20 years, there's no evidence that an increase in rates dramatically forces sales to come to a halt. Nor does home price appreciation come to a screeching stop. Let's look at home sales first. The last 3 times rates increase, that's shown in the graph in red, sales that's depicted in blue, they remained rather consistent. It's true that sales fell rather dramatically from 2007 to 2010, but mortgage rates were also falling at that time. The next 2 instances showed no meaningful drop in sales. Now let's take a look at home price appreciation. Again, we see that a rise in rates did not cause prices to depreciate. Outside of the years following the crash, prices continued to appreciate just at a slower rate. And here's my current proof that these 2 things are not affecting the market in a negative way. The latest report from the National Association of Realtors just got released, and like I said earlier, existing home sales increased in October, making 2 straight months of growth. Of the 4 major regions that gets tracked, 2 of those US regions saw month-over-month sales climb, 1 region reported a drop, and the 4th one held steady. Total existing home sales or transactions that include single-family homes, townhomes, condos, and co-ops rose 0.8% from September to a seasonally adjusted annual rate of 6.34 million in October. Sales fell 5.8% from a year ago. Again, I've said this in this channel. When we compare our numbers to 2020, those numbers are going to be down because we packed so many transactions towards the end of the year as we came out of lockdown. According to the chief economist from NAR, Lawrence Yun, home sales remain resilient despite low inventory and increasing affordability challenges. Inflationary pressures such as fast rising rents and increasing consumer prices may have some prospective buyers seeking the protection of a fixed, consistent mortgage payment. Part of what he is saying here is that inflation is actually pushing some renters to seek or buy homes in order to stabilize their monthly housing expense. And I have to be honest with you, inflation is starting to scare me. Prices of everyday goods have doubled in most cases, and this will have a profound effect on consumers. There will be a lot of first-time home buyers that can and will get affected. The total housing inventory at the end of October amounted to 1.25 million units, down 0.8% from September and down 12% from 1 year ago. Unsold inventory sits at 2.4 months supply at the current sales pace, equal to September supply and down from 2.5 months in October of 2020. The median existing price for all housing types in October was $353,900, up 13.1% from October of 2020, as prices climbed in each region. This marks 116 straight months of increasing prices. This is one of the toughest talks that I have with my buyer clients when they tell me that the market is going down and things are slowing down, and I point to them that prices are still increasing. They have this disconnect in their mind. What is happening is that there's still this continued trend of the flexibility to work anywhere, and it's still contributing to an increase in sales in most parts of the country. Then we have the stock market setting records that seems like every day, and so far consumers are, for a lack of a better description, feeling rich. Properties typically remained on the market for 18 days in October, up from 17 days in September and down from 21 days in October of 2020. 82% of homes sold in October of 2021 were on the market for less than a month. These marketing times are ridiculously fast. These numbers are for the national numbers. For context, it used to be 60 days on average to get a home into contract. In October, first-time home buyers were responsible for 29% of sales, up from 28% in September and down from 32% in October of 2020. NAR's 2021 profile of home buyers and home sellers, released earlier this month, reported that the annual share of first-time home buyers is around 34%. Individual investors or second home buyers, who make up many cash home sales, purchased 17% of homes in October, up from both 13% in September and from 14% in October of 2020. All cash sales accounted for 24% of transactions in October, up from both 23% in September and from 19% of October of 2020. That's a significant increase. That goes to show people with money are still seeing the upside of buying homes. I'd argue that a lot of these investors are actually buying houses as a hedge against inflation. Distressed sales, foreclosures, and short sales represented less than 1% of sales in October, equal to the same amount seen the prior month and also October of 2020. Foreclosures are real and it affects real people. I don't want to see a single homeowner or a single family gets foreclosed. I think that should be zero. Let's look at interest rate. Interest rates, according to Freddie Mac, the average commitment rate for a 30-year conventional fixed rate mortgage was 3.07 in October, up from 2.9 in September. The average commitment rate across all of 2020 was 3.11%. So interest rates are slightly up, but when you compare it to last year, it's still down a bit. Now, here's further breakdown of the numbers. The median sales price is up $360,800 in October. Existing condos and co-op sales were recorded at a seasonally adjusted annual rate of 680,000 units in October, down 2.9% from 700,000 in September and down 5.6% from 1 year ago. The median existing condo price was $296,700 in October, an annual increase of 8.7%. Here's our regional breakdown. Existing home sales in the Northeast fell 2.6% in October, registering an annual rate of 750,000, a 13.8% decline from October of 2020. The median price in the Northeast was $379,100, up 6.4% from 1 year ago. Existing home sales in the Midwest rose 4.2% to an annual rate of 1.5 million in October, to a 6.3% decrease from a year ago. The median price in the Midwest was $259,800, a 7.89% jump in October. Existing home sales in the South increased 0.4% in October, posting an annual rate of 2.7 million, a 3.5% drop from 1 year ago. The median price in the South was $315,500, a 16.1% climb from 1 year ago. Existing home sales here in the West neither rose or fell from the prior month's level, registering an annual rate of 1.3 million in October, down 5.1% from 1 year ago. The median price in the West was $507,200, up 7.7% from October of 2020. Those are the latest numbers from the National Association of Realtors. The bottom line, there's a lot of misinformation out there. You have to sort through the information to get beyond what is really happening. Happy Thanksgiving. I'll see you on my next video.